Hello there. We're talking about capital projects, debt service, and permanent funds in governmental accounting. So the first thing we're doing is we're going to think about the capital projects fund. So a capital projects fund is a major source of funding for capital projects, and it's usually funded by the issuance of long-term debt. Now notice when we say issuance of long-term debt, we're primarily thinking about bonds. We're not really thinking here about loans because you wouldn't typically think of a loan as being issued. So in our example below, you might imagine the city of Portsmouth is planning to budget for the construction of a courthouse, the construction of a new city hall, something like that. So in number 2, the first journal entry, the city council votes and they approve a budget of $1,500,000. So what you see here is a debit for encumbrance control for $1,500,000, and you see a credit to budgetary fund balance for $1,500,000. Notice that a major part of this capital projects work is to be done by a contractor. Now, when the city actually sells bonds, they go into the capital projects fund and they debit cash, in this case for $1,212,000. What happened here is the bonds face value was $1,200,000 and they were actually sold at a $12,000 premium. Now, if you go to page 123 of your text, it's not something I'm talking about in this slideshow, but if you go back there and look, what you'll see is the capital projects fund actually needs to transfer out the premium. And typically they'll transfer it to a debt service fund. And so what we'll start talking about next is how the debt service fund will be used to pay back the bonds. So a city will have debt service funds to provide payments of interest and principal as they become due. They're not created for debt issues if the proprietary fund, or if a proprietary fund is intended to generate sufficient cash to make the principal and interest payments. So what we mean here is, imagine that instead of Portsmouth using the money for City Hall or for a courthouse, imagine they're using it for Bide-A-Wee golf course or the Portsmouth City course. So in this case, if they're using the bonds and they fully expect greens fees and cart fees and fees from the concession stands to pay back all the maintenance, all the other costs, and the bond principal and interest, they wouldn't use a debt service fund. Instead, they just treat everything through the special revenue fund. But as we talked last week, it's very rare that a city can create a special revenue fund for its golf course because golf courses aren't usually self-sufficient. So if the golf course is not self-sufficient, that could be another thing that the capital project was set up for, and indeed that now we have a debt service fund for. Notice that under the modified accrual basis here in number 3, interest on long-term debt is not accrued. Instead, it's recorded in the year the interest is legally due. Now that's a significant difference. So you remember that if this is a for-profit organization, they're going to record all the interest that's legally due, all the interest that's accrued the minute they take out the loan. That doesn't mean they're going to record all the interest ever. They're going to record all the interest that's accrued. And I only point that out, really it's beyond the scope of this class to keep thinking about it, but I only point that out because sometimes you might have, for example, a 30-year amortization schedule for long-term debt. Well, if prepayments are allowed, there really is only perhaps a month of interest that's accrued. I'm just saying here, even if the contract is going to require that interest is paid later, but not in this year, we still don't accrue it now. They're going to owe it, but we're not going to accrue it now. So the rationale here is that the current year resources don't have to be expended for the future year's interest, only for the current year's interest. And that's a little bit different from the type of accounting that you're used to. So now we go on with our example, and we're in the debt service fund. Notice that we're no longer in the capital projects fund, but the city of Portsmouth, just as we talked before, authorized an issue of $1,200,000 8% tax supported bond. So this means that whether it's the golf course or whether it's one of the other buildings we talked about, taxes are going to be used to pay these back. So when the authorization was done, there's no entry necessary in debt service. But as we saw earlier, in that case, and in this example, the entry was necessary in the capital projects fund. Remember back then that we talked about how the the premium was transferred out of the capital projects fund. And so that's what you see here in A, the first entry, is you actually see the premium transferred into the debt service fund. So you see the $12,000 in cash, and you see other financing sources transferring it in. In B, we now have a principal payment due, and we have bond interest due this year. And so we have two debits, both to expenditures. So these would have 600 numbers like you would see in a for-profit expense chart or expense section of the chart of accounts. So we have expenditures for bond principal, $120,000. We have expenditures for bond interest, $48,000. These have to be separated. Legally, if the city needs to file for bankruptcy, if the city, can't pay on time, that type of thing, principal and interest are legally separate payment streams. And so it's imperative that they be in separate accounts. Our credits then are to matured bonds payable. That would have a 200 number. And another credit to matured interest payable. That would have a 200 number. But again, just like the debits, these would be in separate accounts. Chapter 5 also deals a bit with permanent funds, and we're not so much going to talk about the accounting of them here. There's not a lot of talk about it in Chapter 5, but we are going to talk about what they are. So permanent funds are usually the non-expendable part of a trust. So for example, an individual, the book talks about how the individual drives past a cemetery and is disappointed that the city's not upkeeping it the way they wish they would, and so the individual provides a trust. They say, here's some money, maybe here's some investment. Here's an investment account. City, you have to keep this. It's in trust. You keep it, but you can't spend it. Instead, you can spend the earnings. So if I give you $100,000 and it costs $10,000 a year to maintain the cemetery, or $10,000 is my contribution toward that, you can take the earnings, and you can use the earnings to make the expenditure payments, but you can't take the principal. Instead, you have to keep that separate. Well, that separate money then, or those separate assets, wind up being a permanent fund. It's important to note that the government can't change permanent funds, so they can't change the purpose of the fund without the consent of the donor. The donor could do that up front. They could say the government may change it, but if they don't, the government would have to go back and ask permission if they wanted to spend in this case, the principal. And examples of permanent funds would be things like principal for cemetery upkeep, for library upkeep, museum upkeep, and etc. Well, hope this was helpful, and let me know if you have questions on capital projects, debt service, and permanent funds.